Hello and welcome to Crypto Weeklies. In this video, we are going to discuss about stacks and its token STX. None of the content is financial advice. Over the last key performance periods, stacks has rallied quite a bit. Over the last 24 hours, about 10%. Over the last 7 days, about 20%. Over the last 30 days, though, again grabbing the number third spot. 1, 2, and 3, 1, 3, and 3 respectively on this performance barometer, where we track major cryptos and how they're performing as opposed to each other in a comparative analysis. Over the last, you can see over here as well, stacks market cap has gone above 1 billion, volume at around 150 million. In terms of tokenomics, about 83% of max supply is in circulation. So going forward, any impact of token dilution should be minimal at this point. If we check between the price versus market cap growth or lack of growth in the last 1 year, again essentially one and the same chart. That means whatever happens to the market cap gets reflected fairly back into the price without affecting any major token unlocks related dilution. You can see right now, per the token unlock schedule, we are right now at a precipice where going forward the unlock schedule would be more of a linear than an exponential growth in token releases. That should bode well from an inflation perspective for the token holders. Again, going back to stacks at around 70 cents, going to our website cryptoweeklies.com, let's analyze where this price point looks in the history of stack. And with respect to the polynomial regression function, which is this gray line, understand how overvalued or undervalued stacks is at any point in time with respect to risk reward. Right now the fair value per this model is at around $1.31, whereas the current price is at around 70 cents. That represents about a 5% risk. And again, if the hypothesis is with any altcoin is only to DCA, whenever the risks are less than, let's say, 10%, over here this model does identify some of the best times to DCA. And opposite of this is again when to DCA out, a range where, let's say, there are no guarantees that every single rally goes to the 100% risk level. Again, 0.4 to 0.6 or 40 to 60% risk, that historically speaking has provided some area of analysis where the prices could go, a forward looking guidance, if you will. And again, corroborated with this dotted red line, where right now that dotted red line does have a slope of towards the downside, but right now the price ceiling per this model is $3.62. The current price of stacks being at around close to 70 cents, roughly speaking a 5x from here. If let's say the dotted red line does have a future, if you add a future peak regression slightly diminished, somewhere at around $1.50 by September, or by October at around $2.50 to October at around $2.20. So if the price does eventually catch up to that level, that would still be a 3x from the current price, if that were to materialize. Again, not financial advice. Now, on the other hand, if we take a look at, rather than peak regression, if we look at another metric, which is the bottom regression, again, prices have not come any time close to this bottom one standard deviation regression line. That means stacks relative strength has held again a series of fairly obvious lower highs and higher highs and higher lows since about March 2020. Now then one back in December 2022 around 20 cents, and now potentially at around 50 cents in April 2025. So just wanted to highlight it in terms of what this model price points could look at. Let's say 40% risk, $1.83 stacks per this model, till about $2.67, between 40% and 60% risk. That's where the target per the analysis of this model is. If you look at some of the technical levels for stacks, you'll find that the key level to watch for is this 21-week exponential moving average that is coming down at around $1, roughly speaking $1, and the 20-week moving average is at around $1.06 level. $1.06, as and if the price tries to catch up with that declining 20 week and 21 week, like it did back in since about June 2022 till about January 2023. There were a couple of instances where whenever the price kind of went to this 20 week and 21 week exponential moving averages, there was a resistance for 1, 2 and 3 and potentially 4 iterations while it was in a declining phase. When the prices had bottomed again, a double bottom is not that unusual. So if we see a double bottom at around 53 cents in the future, and then as this price versus this 20 week moving average kind of balances out with some tests to the upside as well as the price moves up, whereas the 20 week and 21 week balances out and tries to have an upward swing on its own rally. Then at that point in time the stacks could take off if those criteria were met. So again, for now the 20 week and the 21 week is at around $1, roughly speaking $1, so about 30 cents from here. So let's monitor if the prices do eventually go to that level. So with that we can just focus some more attention on the simple moving average based analysis. This is the same chart essentially. Instead of looking at this 20 week moving average in isolation, what we are doing over here is color coding the risk levels based on how the price is doing with respect to the 20 week moving average. Again, this model, if we look at some of the major rallies, they occur between, again, 40% at least. They occur somewhere between 40% risk and about 60 to 70% risk. So if we have that kind of framework in mind to have that hypothesis that eventually as the prices kind of go to between 40 to 70% risk, looking at the price at that point in time makes most amount of sense. What the price could be if the prices were to go to that risk band. 40% risk for stacks per this model is between $1.97, almost a $2 level. So roughly speaking, slightly under 3x from the current price, whereas the end of the 65 percentile is 65% risk is at around $2.50. So roughly speaking, in terms of risk reward, a 3.5x from the current price of about 70 cents. And the higher end for this model is at around $3. Where the price, if it were to go to the max risk level, it would be at around $3 for stacks. That presents slightly realistic picture for what the prices could be. In terms of the time weighted average price though, the blue line usually, especially looking at it historically speaking, if the underlying asset does have some utility or some fundamental strength, accumulating below the time weighted average price, historically speaking, it was a good accumulation zone. Right now the time weighted average price for stacks is at around 96 cents, close to that 20 week simple moving average, and the prices are lower than the time weighted average price, signaling an accumulation per the time weighted average price based model. And with this, I would like to conclude the video. Hope you enjoyed the content. If you did, please give us a like and subscribe, and you can check out all of these charts for free on cryptoweeklies.com. The link is on the bottom of your screen, and hope to see you again tomorrow. Thank you and have a nice day. Bye bye.